All right, welcome back to American History, Lesson 2 for Chapter 6 and 7, the Great Depression and the New Deal. Lesson 2, today we're going to talk about the actual crash, the stock market crash, which triggers the Great Depression in the United States. So first and foremost, we got to talk what happens, because it's a cause and effect style of event. The cause behind why the Great Depression happens, they are overproduction. We have way too much stuff. Agriculturally, farmers, last section, we were talking about how they overproduce. There's way too much beef. There's way too much pork. There's way too much chicken. There's way too many grains being grown. Factory, industrially, they're producing way too much stuff and nobody's buying American goods. There is already at this point a great worldwide economic slowing. Okay, and we'll talk about that a little bit later in this chapter as to why that was happening. But the economy is slowing down and people are still producing as though things are good. So overproduction is going to make a huge impact. Remember, we talked about supply and demand. We have way too much supply. There is no demand. Nobody's going to buy stuff. The second reason is bank failures. Okay. Banks close, people lose their money. There was no such thing as the FDIC at this point in time. If the bank closed, if they ran out of money for one reason or another, and you had your life savings in there, you lost it. Okay. People were taking out loans on huge tracts of land to start businesses because the 1920s seemed like a very prosperous time for average Americans. And banks made a huge array of very poor business choices, loaning out money to high risk people going bankrupt, the banks not recurring that cost, not getting that money back. And then because they had loaned out huge chunks of money to people with poor business choices, they didn't have money to give people back when they wrote checks or tried to cash in their savings. Okay, so people are going to lose their life savings because of bank failures. And this starts a very, very vicious cycle. Factories, farms making too much. They have to lay people off. So now people aren't making money. Farms prices fall, so they're not making money. People are going to default on loans that they owe to the bank. When you go into default, the bank is going to take things away from you. And if you have nothing of value or the bank can't recur the cost, the bank are going to close. People are going to lose their lost saving or their life savings that's in the banks. And this just continues to go round and round and round. Okay. Many banks are going to close across the United States. 1926, left side of the graph. 1926, there are about 27,000 banks in the United States. Across the U.S., there's a good number of banks. Before we even get to 1929, 4 years into this graph along the bottom side, you'll see banks are starting to close already. Thousands of banks are starting to close because of those poor investments. We haven't even talked about the stock market crash yet. Banks are closing. People are losing their money. This is warning signs, red flags today. Okay, and then you see 1929 to 1930 to 31 to 32, 33, the lowest year on there. Banks close in huge numbers, somewhere to the tune of about 15,000 banks across America close. So the causes of the Great Depression are overproduction and bank failures. The spark, what ignites this, kind of like Archduke Franz Ferdinand's assassination ignites World War I. The stock market crash is what sparks the Great Depression. Okay. On Tuesday, October 29th, 1929, investors began to sell stocks in huge numbers. Okay. Massive sell-offs, prices are falling. People are trying to get as much money out of the stock market as they can as they see their prices falling. And this is all driven because people had seen the stock market reaching new heights each and every day. It seemed like every day the stock market was reaching heights. So here's a couple of terms to throw at you. The Dow Jones Industrial Average. You might hear that today. We use this as kind of a barometer. It's the top 30 stocks in the New York Stock Exchange. And whether the top 30 as an average are doing better or worse than they were yesterday. So you might hear that the Dow is up, meaning that they're better. You might hear that the Dow is down, meaning that they're worse. Okay. Speculation, second term in here, buying stocks or bonds with the chance of a quick profit, meaning I'm going to go in, the stock has been growing the last few weeks, so I'm going to invest today with an intent to pull my money out in the short run, in a week or 2 weeks, try to quick turn and profit. What this does is they see people go in and invest real quick and then sell off, causes people to think maybe something's wrong with this stock. And so other people will sell off their stock, which artificially causes the price of that stock to drop. And the third here is buying on a margin, essentially borrowing money to buy stocks. You could buy a stock on a margin. If it's a $100 stock, you could go in and pay $10 for it up front, kind of like the installment plan. And if the stock continued to grow, eventually that $100 stock might be worth $150. So now you have $60 invested. Wait another few weeks, maybe it's worth $100, or maybe it's worth now $220. So actually, you're getting a dividend. You're getting a paycheck back now, and at that point, it has paid itself off. As its value increased, it would pay itself off. So people could get into the stock market for really cheap. The problem is, if the stock market crashes and you went in with a $100 bill and said, hey, I'm going to buy 10 stocks for $10 each, now you actually owe $900 instead of $100. So it could flip on you real quick. And we see a huge issue with this is of Americans that invested in the stock market on a margin, like the installment plan, overextending themselves financially. So Black Tuesday, we call it Black Tuesday because the stock market bottoms out. Okay, people see the stock market crash. Some of them have bought stocks on a margin. They see that they owe a bunch of money. They're going to run to the banks. It's called a run on the bank to try to go get their money out of the bank so that they can pay off their stocks in an emergency. Many of these banks have loaned out too much money. And once the money is gone in a bank, they close their doors. And so people are lined up outside of some of these banks that just have to say, I'm sorry, all of our money is gone. We are closing. I'm sorry that you lost your $100,000 life savings. And so people lose that. They have to go back to the stockbroker. The broker says, hey, you got to give me money, sell your house. Or the broker is left holding the bill. And so there's a lot of money owed as the stock market continues to crash. Here we look left to right. You see how it peaks about 390, which is a very low price if you're looking at the Dow today. But then it bottoms out, and it continues to bottom out as we work towards 1932. So in conclusion here, there's two causes to the stock market crash and for the Great Depression starting. There's two causes for the Great Depression: overproduction and bank closures. And then the spark, what reveals how bad the economic conditions were in the United States, was the stock market crash. All of these things put together lead to the Great Depression. Okay. The result, millions of unemployed Americans, upward of 12 million Americans, 1 in 4 Americans will be unemployed. Some of them, most of them will be jobless and homeless. And many Americans lose their life savings that they had wisely invested in the bank. And that leads us to lesson 3, the hated Herbert Hoover. And we will come back with lesson 3 here shortly.